Well, can we finally take a break? Well, the answer to that is no. So what we're going to talk about today is the economic events that are happening just today that are going to affect the markets, and we're seeing rates surpass the 6% range again. Remember, just a couple weeks ago, we were about 5.25%. So we had a huge push in mortgage rates since Federal Chairman Powell spoke at that summit last Friday. But headline news today, and this isn't good news, folks, and I'm going to show you why here in a minute, is China and Taiwan are going at it again, and I hope that we don't get involved in this conflict. So we have China. They're looking to possibly invade Taiwan, and that's been in the headlines for the last 6 or 8 months, but you really don't hear much about that. But what normally happens during conflicts like this? Well, great question that you had, because I did my due diligence, and here's what I found. And this is pretty eye-opening. Let's go back into history in wartime and recessions and everything else. So let's draw down through here. This is from the History Channel. And you go down through, and I'm just going to show you some major events that happened and what the results of those events were in the economy, and especially at the Federal Reserve level. So let's get into it. The first piece of the puzzle here is a recession is defined as a contraction in the economic growth of the last 2 quarters or more as a measure of GDP. Well, unfortunately, that definition doesn't hold water anymore. Don't know why, but let's just go with it. So let's just go back in history to see what happened during war times, because we might be entering conflict right now. And is that good for the economy? Is that good for housing? Is that good for interest rate? Is that good for all of us? Well, the answers are a little bit mixed. So if you go down through here in World War II, what did we see? As the government spending dried up, the economy dipped into a serious recession. Does that sound a little familiar? The government spending, sending money out to everybody, is drying up, and it's pushing us into a recession, but we don't want to admit that it's a recession. So that's piece one, and I'm going to go through multiple events, and you'll get a theme here. The next piece of the puzzle is November of 1948, the post-war. What happens is consumers rushed out to basically pick up their pent-up demand on purchases. Kind of after the pandemic, what happened is we saw a V-shaped recovery in the economy. Everybody rushed back into the markets and just started buying and buying and buying. That's what pushed up the inflation piece on that end. We continue to go down through this article. When the consumer spending boom began to level off in 1948, it triggered an 11-month recession. So I'm saying that's what we're in right now. The next piece of this puzzle is we go into the Korean War. Heavy government military spending dried up after the end of the war. Do you see how government spending, is involved, and what happens after those? Well, after the post-Korean War, a recession took place, and it was kind of helped out or pushed a little bit in, we'll just put fuel on the fire by the Fed, and it pushed in, a recession. The high interest rates intended to slow down the economy. It did, and it did too much dramatically because the Federal Reserve overshot like they normally did. So what happened is, well, just a couple months later, the Federal Reserve decided to lower mortgage rates, or no, lower interest rates. I'm sorry about the mortgage piece of this. Now let's go into the next conflict, the Asian flu pandemic. In 1957, is that what we might have saw in the corona piece of the puzzle? Because wasn't it from China? Wasn't it kind of flu-like symptoms? Just saying. Okay, so now you go back through this, and let's see what happened during this conflict. Well, again, the economic problems were compounded by the Fed raising rates to slow down inflation. All right, so what was the end result of that? Well, we scroll down through here, and how was that solved? Well, you go down through here and buy a boost in government spending. Are you getting a theme here? Then we go into 1960. 1960, let's see what's going on during this time. The second cause was the Fed again, which raised interest rates fast on the heels of a previous recession in an ongoing effort to rein in inflation. Well, then what happened right after that? In response, the Fed once again started raising rates, but they were forced to do what? When the Federal Reserve lowered rates again in 1970, the economy cranked back into growth mode. So let's look at the pattern here. We have pandemics and everything normally caused by the government, and then the government increases their spending. They might spend it on war. They might spend it on checks out to consumers. Then the consumer, when the pandemic or the war, everything's over, they rush back in the market, spend, drives up inflation, aka what we're seeing today. And almost every one of these events, what happened? The Federal Reserve raised rates going into each one of these, and throughout it, put us in a recession. Then within a couple months after that, they were forced forced to bring down the rates again to help the economy. So that's that piece of the puzzle. I'm just showing you the history. I'm not making up this stuff. The next piece of the puzzle right now, why are we not in a recession? Everybody is saying, well, the robust jobs market. Gangbuster jobs growth add more confusion than recession worries. So that's what we just saw, recently. And then you see today's numbers. Jobless claims total 232,000, the lowest level in 2 months. Well, I'm like, wait a second. I know that people aren't going back to get to jobs because there's 11.2 million job openings that was just represented this week from the JOLT index. So let's get over to the economic calendar. I'm going to show you some conflicting information in regards to the jobs report. So let's go over to the jobs market here. This is United States employed persons. Okay, so let's look at this chart to see, are things really as robust as they say? So we were running into really great times throughout the early 2019, 18, 17. Look at the job growth throughout here. Up. And then all of a sudden we had the tail off. But let's look at where we were and where we are today. Look at this number. We're just under 160 right here, okay? Where are we now? Well, we came up to 150-ish. We're not even up to this level yet, and we're flatlining. So is the job market that robust where we're not even where we were pre-pandemic? That's what we're going to monitor for the future, because I think the jobs market is the only silver lining that we have in today's market. But why are you here? Well, you're here to figure out what mortgage rates are going to do. And unfortunately, guys, I don't have good news for you today. MBS markets are getting hammered. Let me show you this. I think it's down over 30. Now it's over 40. Okay, so let me just put this into context for those newbies out there. I'm going to do it real fast. This is what's happening to the mortgage bond that trades on Wall Street. This is the price of the bond. In its simplest terms, as the price, as you're seeing here, is going down, mortgage rates are going up. There's an inverse relationship. So when this bond price goes down, rates go up. Look at where we are. Down 40. So where are rates? Where are rates been since the last week? Well, last week when we published rates right before the federal chair spoke in Jackson Hole, rates were at 5.25 on a 30-year fixed. Where are we at right now? Well, we started the day at 5.99, up just a little bit from where we were the day before, but this number in the MBS market right now, the minus 40, isn't baked in. So these numbers are probably going to go up a quarter. So we're going to be teetering on the highest rates that we've seen in decades again. So with all this in context, and you looking back over the history, these pandemics, these war times, what happened? Government overspent. Federal Reserve came in and swooped in after the fact because it created inflation, the overspending. Fed came in, stepped in, started jacking up rates to cure inflation. In almost every one of those situations, they had to counteract within months of that because it wasn't working and it was putting the economy in a bigger hole. And that's what we can't have in today's world, especially, guys, don't forget, I keep saying this, it's an election year. So a lot of things are going to play into this because of that. Trust me on that one. So here's what rates are today. These are mortgage rates published by Mortgage News Daily. These are the top 6 products. Why do I use their website? Why don't I use my rates? I'm a broker. I use over 100 different lenders. So that's what I do. So I want to try to post rates for you guys to get an idea where rates are. So I use Mortgage News Daily on a daily basis. For legal purposes, what represents in these numbers, this is a client looking to buy a $500,000 house, putting 20% down, single family home, primary residency, and they have a 740 credit score. Here's where the rates would be on a national average. You can see they were basically flat in the last day or two. That's going to change today. You're going to see rates go up at least 0.25% today. So when I do my video tomorrow, don't be surprised if the 30-year fixed rate is 6.25. So that's my report for today. If you want to find out any more about me and my team, all I ask you to do is go to the rate update. We are a federally chartered mortgage advisor. We would love to help you in that case if you're looking to build, buy, refinance, home equity loans, renovation loans, anything of that sort. Also, don't forget to check out our previous videos that I just did and our most recommended, and check us out on, if you listen to podcasts, go to your favorite podcast channel, just Google Dan Frio or Google Dan Frio, the mortgage update. I'd love for you to listen to us because I put this content on there plus much more. So thanks for watching, guys. Appreciate it. Give us a thumbs up, subscribe down below. Hope to see you tomorrow. Bye-bye.